Welcome, ladies and gentlemen, from me, Guy Monson, to our regular 6-minute strategy summary. This week I'm going to look at the jitters in world markets and what lies behind them. From the October 12th peak, US equities are down about 8%, European equities down about 10 or 11%, and for the world index as a whole, last week was one of the worst since the March bear market. What lies behind this? Well, first of all, there are understandable jitters in the run-up to the US election on Tuesday. Will the US president concede? Will the election be contested? Will there be problems in state votes passed up to the Electoral College? All of these are particular worries. Secondly, we've seen some shocking COVID data, particularly out of Europe, but we've also seen record infections at a daily rate out of the US. Thirdly, all this is triggering fears of a new lockdown and with it a W-shaped recovery, a slip back, if you like, into a double-dip recession. This is putting some question marks over earnings, and we've even seen a giant like Microsoft be a little bit more cautious on its guidance. Let's look at this in more detail in the slides ahead. So let's begin with world equities on slide 2. You can see that despite the sell-off, still very strong performance from US Nasdaq and the Chinese equity market, the winners, if you like, of the post-COVID world. Global equities themselves, after the sell-off, broadly flat for the year to date, still a sharp underperformance in blue for the UK FTSE All-Share, clearly a beneficiary for us as a global investment house. On the right, you can see the uptick in volatility. I've gone right back over 20 years, and at 37% or so for the VIX, while nothing like the levels of the financial crisis or the first COVID sell-off, it's still elevated at around about the levels of the Eurozone financial crisis or so. That's quite unusual for what has been a bull market, and you can see this in a little bit more detail on slide 3. That volatility in red creeping up, in line also with a rise in US bond yields. That's putting a little bit of pressure onto valuations, which of course are elevated after a 10-year bull market, and particularly after the fall in profits that we saw from the COVID crisis, 29 times for the S&P 500 multiple. The second reason, of course, that markets are fragile is the surge in newly identified COVID cases, particularly in Europe. You can see there's very sharp rises in France, the UK, Italy, and even Germany, well above the highs for weekly confirmed cases that we saw back in April. On the right-hand side, you can see while the US is bad, a record weekly number just come out, it's in fact in total terms well below Europe, and that's where the real pressure is. Now the worry, of course, is that this triggers much more severe lockdowns. I put here on slide 5 the City Mapper Mobility Index for Paris, which tracks various transport networks. You can see that falling sharply to almost zero in the March-April lockdown. The worry is something like this will happen again, and that will feed through into business sentiment and cause a sharp deterioration in underlying economics. I'm afraid we've got to deal with the real risk of a W-shaped recovery and a double-dip recession. The third and obvious reason is the tension in the run-up to the US election on Tuesday. I ran these numbers last night. Biden is still nicely in the lead, but that lead coming a little bit to around about 7%. On the bottom left-hand panel there, the indications for the Senate are still in favor of a Democrat win, so that blue sweep, probably the most likely outcome. The Democrats have had some advantages. There's certainly been, according to the academics we speak to, a shift towards older voters who traditionally voted Republican, were a buttress, if you like, to that young Democrat vote. Secondly, of course, Democratic fundraising has been very strong, so their spend in some of the marginal seats has been dramatic. But Trump improving in Florida and in Wisconsin, so it's very much a risk of a contested election out there and clearly recognised by markets. What are we looking for? Well, a really clear 270 electoral votes uncontested on the night would probably, according to our advisors and academics, see us through to a relatively straightforward outcome. But it's going to be a tough few days before then. So let's put this together in terms of markets. I've shown here the S&P 500 for 3 electoral years. 16, the uptick into a Trump victory. 2000, the sharp downward fall on that contested Bush-Gore election, with the count in Florida finally taken to the Supreme Court a month after the election. And the red, the S&P 500 for where we are today, hovering between those two outcomes. So you can see the fear of a contested election. What does that mean for our strategy? Well, we would broadly see a sell-off from here as a buying opportunity. some opportunity to add to the long-term value we're looking for in equities. Why is that? One, because we expect further stimulus. Madame Lagarde has been out today to say that the ECB will be recalibrating its own tools. We would expect the fiscal stimulus in the US to come through very sharply and aggressively on a Biden victory. Finally, we see an escape from some of the super high valuations in the utility and industrial sector that will be real winners from the green revolution that we've talked about so much in these talks. So I hope that gives you an idea of what to expect in the run-up to the election on Tuesday, and I'll be talking to you more in the aftermath on Friday in a week's time. Thank you.